Hey everybody, Austin here. Gonna do another trade recap. I'm doing it in the middle of the night, so that's why the light's on. I'm sorry if there's a glare. But before I do, I want to say I'm not licensed or registered. I'm not a financial advisor, and none of this should be taken as investment advice, even if it sounds like it. Okay, so yeah, I had a few trades last week, and I like the reason why I'm doing this, I guess a little late, is because I couldn't really decide which one to do it on. So I remember in my Thursday webinar, I asked like which one you guys would like to see a recap on, and like people shout out CETX, XSPA, and or ATOS, something that they want to go more in depth. Some people said all of them. I'm like, well, maybe I can kind of go over through all of them, but like talk about the specs that really make them, the details that make them alike, and whatever. But anyway, I want to go over CETX. That's what most people said they wanted me to go over. And CETX was a trader on Thursday, and the thing about CETX was it was kind of like the big runner of the day. We've kind of been having that, right? So you always have to be careful when you're trading the big runner of the day because kind of everyone's attention is on it. So stuff I don't like to do is stuff like chasing, right? Chasing is stuff I don't want to do. I'd rather wait for kind of a more established, well thought out setup. And so like I thought I was putting dips here as this went on in the morning, and it just didn't dip. It just kind of went parabolic up, and I said, okay, whatever, fine. Like I missed this, and then I was like, oh, let me catch the dip, let me catch the dip, let me catch the dip. It just kept soaring. I'm like, fine. I wasn't gonna chase, right? I was waiting for the dip. But anyway, so I missed that, but I kept watching it throughout the day, and one of my favorite setups kind of came up. And it's where we get it's kind of where we get this like this hard pullback that says, hey, this might be the top. This is the first hard pullback that says this might be the top over here. And we start to downtrend and make a couple of lower highs, and then we get this mean slam down kind of in the middle of the day where it might think that everyone might think it's done, right? And so this is kind of the short trap here, the hard pull, the lower high, and the breakdown here. A key thing to note though is that like where it initially broke out from 350, it's still holding, right? Like this consolidation is still a support, so it's not like a death line crack, where a death line crack is like when the whole no support is left. We broke out here from 350, that's still there. These are dips, like $3 consolidation. You could probably consider that the death line, right? $3.04. Or like the last support, basically. This was not it, right? A lot of people want to try to anticipate like a higher death line so they can get a better average, and they can. They just have to know that like the move might not be over until the last support is broken. So that's kind of why I like to stay cautious on the short side, where if I'm shorting not like a death line crack, I'm very aware that there's a potentially larger move that is still on the front side. So anyway, this is essentially what I consider to be, like, I'm not even thinking about this as a long right here. Like, I'm like, okay, that was a hard crack. Let's see what it does. And this is kind of an example of the setup that I kind of, the concept that I've talked about before, but if you haven't heard about it, it's a good refresher when and I talked about it in my webinar, when it's trade when something that should happen doesn't. Another way to call this is this. I call this another form of like a reactive trade. Like another word to call this is like a reactive trade. And in my opinions, I talked about this in the webinar, reactive trades are in one way my favorite kind of trade, because there's no guessing, right? A lot of times, like if you were to buy here at 350, you might be like, okay, maybe it keeps going, and there's always going to be the maybe for the outcome, but maybe this is a good setup, right? You might have that question, it's day one, it's holding VWAP, it's holding trend, maybe it's a good setup, but then something else comes and tells you, hey, you're buying high of day, right? This isn't a good idea, and you have these conflicting ideas, so you don't know, necessarily, like you're always going to have a doubt if it's a great setup or not. And so whenever you have a doubt, that means it's not, right? If you're ever doubting about it, it's not. What I love about these reactive trades, trade when something that should happen doesn't trades, what I love about them is they're typically not guess. I don't guess. I'm like, wow, this is a good opportunity. I have to take it, right? So this is kind of like, and this is why a lot of my videos are kind of on failed breakdowns. It's because I get to see the first half of the trade happen, unfold, fail, and now if one didn't work, what's likely to work, right? If the first half didn't work, then the second part, if one side of the trade didn't work, well, if we can't go down, where can we go, right? So that's kind of the thesis behind these longs and also behind some shorts, right? I think last week I went over a trade where stock peaked out, like totally stuffed high a day. I'm like, well, if it can't go up, it's got to go down, right? And so I shorted. So this is just kind of the flip of that, where this is like a failed breakdown. People anticipating this to be the breakdown from the high, the supposed high of the day going forward, this lower high and fail, and then a nice stuff here, right? Just people expect this to keep going. Probably a lot of shorts pile on here, sub VWAP. And then, then we immediately pop back, and this is not what shorts want to see, right? So I said I started talking in chat that over 430 is trouble, right? Like, because this is where everyone might change their mind, right? Longs might get excited, shorts, anybody who shorted post high of day here is not happy about this reclaim. Like, imagine this reclaims 430. I mean, we can scroll back a little bit. We can cheat, or let's not cheat. If you shorted anywhere from like this red candle to here, like above 430, and we're in the 440s, like it's hard to be comfortably happy with an average. Like 440 is like right here. That means you got anyone who's comfortable is like right up in here. This is the only comfortable people left. These people aren't comfortable, right? Like it's right next to their average, right? So it kind of it's the spot that puts shorts uncomfortable and it gets longs excited. So that was the idea for the 430. Now, when I come into this trade, I'm like, if we ever, I like that this is not breaking down as a long, and I'm like, but if I'm buying up here at 430, the idea is to trigger this 460 stop and eventually the $5 stop, because maybe everyone just panics out. That's the idea of the trade. But what happens, how do I like justify buying here at 430 with what? 380 risk? 390? Like, like let's call that 380 risk. That's decent risk, right? That's like 50 cents of risk. That's like 50 to 40 cents of risk depending on how you want to go about it. And that's assuming you get 430. There's probably going to be some slippage. So what did I try to do? I tried to group a level to where, and you can, this is a technique called grouping, where you can, if the levels are close enough, you can almost treat them as the same level. And so you can do this depending on how thin a name is. If a stock is really, really, really thick, like General Electric, for example, like $7.10 resistance and $7.20 resistance are probably going to be really, really, really different resistances. And, a break of one just means that you're going to have the next one to fight, right? Because the thickness almost shortens the size of the domino. But this is the domino effect, and if you can group certain levels together, maybe the domino can push both of them over in one swipe, and that's the idea. So I was thinking $4.10 was the perk here, and I'm thinking if we can get over 410 with the thinness of this stock, with the small float that it has, it's probably going to skip to 430, right? We can skip to 430, and if we can skip from 410 to 430, I'm pretty sure shorts aren't going to be happy about that, and we're going to ignite. So basically, it means that I moved my level where I think the tides changed. The inflection point is at 430. What I did was I said, is there a better level? I moved it down to 410, and I put my money on that. But I didn't go all in at 410. What I did was I put 2/3 on, and then when we truly, truly confirmed, I put the rest on. I put the other third on over 430 because it is a larger reward to risk ratio. It's more risk for the reward, right? Because if the risk is down here, this is a better entry than that. So the trade, my trade was essentially this. Like, I'm just pointing it out, and I sold into the covers, which is the idea. The idea was to sell into the stops, right? So I want to bring it as high as it's going to go, but if we run out of covers, I kind of want to get out. So like I tried to be patient on a little bit. I think it was like a fourth or fifth of the position. But you know, when the covers seemed to run out, I got out. So yeah, I mean, I basically just exactly how I explained it. I got in over here at 410, added a little bit over 435, and like I said, like I didn't get 430 on the nose. I remember I had 435 on my order entry ready to go, and when we broke 430, 440 was on the ask, and then I tried to hit 440, 445 was on the ask, and I took that because like that's just I know it's proving, like I know it's a little bit of a chase. But in this instance, when you're going for a big squeeze, when the target's 5 plus, you don't want to be, you know, squiddling over 5 cents, right? When your target is well above the means. And the fact that it's really thin and that it's skipping is really almost good for you, that you almost have to chase a little bit, because, you know, it means that if you're chasing to get your entry, who's chasing to get their covers, right? So this is kind of why, like, I knew I wasn't going to be comfortable chasing full size up here, which is kind of why I anticipated my emotions in that a little bit, and I was able to move my thesis down to 410, right? So it's not like me anticipating the trade. It's me trying to, you know, get a microscope in on the trade and say, is 430 the best entry for my thesis, or can I move it down? And I predetermined ahead of time that I could bring it down. There's a big difference in saying, like, oh, like I'm anticipating the trade, let me get in before the trade is valid. No, in my mind, I made the trade more valid at 410 because I could reasonably justify the grouping given the thinness. There's a big difference between anticipating the trade and actually changing the trade to where you think maybe I can be smarter a little bit, be a little smarter and not wait for 430. Maybe the trade works from 410 instead. And I turned out to be right. But anyway, this is an example of a reactive trade. I'm reacting to this failure to break down to enter. And another example of this was like on XSPA. This is a more clear-cut example where we were really like this is kind of a similar situation. We squeezed up and we failed hard. This failure, this hard failure and this consolidation, a lot of people who got squeezed out here are really frustrated that they covered here when we tanked down here, right? So me knowing as a short, what's going on here is people are, wondering if it's going to come back or not. And this slam kind of shows the FOMO. It almost shows the hand so that when this immediately rips back, click. This is a reactive trade. You're now reacting to what just happened because this is what was supposed to happen. And when it doesn't continue, this is the time to enter. It's a reactive trade. It's no longer a guess, right? You're not guessing that the setup is there. The setup just proves itself right here. It's not like it's still a guess on the outcome. You're never ever going to get away from that in trading where you know what's going to happen. The outcome is always going to be a maybe. But in this situation, the setup is no longer a maybe. When I see this big candle immediately mirror this red candle, I immediately know someone's trapped. So the guess of is this a valid setup or not is gone. And this is why it's my favorite setup, because I just know immediately I have to get in, right? It's no longer a guess, because one, the risk to reward is really good. It's really easy. This was a really easy trade to get in, but it mirrors the concept of trading when something that should happen doesn't. It's my favorite trading concept because it leads to my most highest probability trades, and they don't happen all the time, I will admit, but like if you're trying to build a new account, like these are kind of the trades that I find the most helpful, the ones where they may not happen every day, but they're really high probability setups, and they're decent risk to reward too, So just an example to go over that concept. I wanted to go a little bit more in depth on it. And one more thing to note, in both of these examples, CETX, when both of these were kind of the same thesis as far as I want to sell into covers. When you get big squeeze fueled by covers, one thing I don't like to do, and I mentioned this in the webinar, I want to go over it again. When you're trading off big squeezes, I don't like to, off a super vertical squeeze, I do not like to dip buy. Dip buying stocks is not something I want to do on huge vertical squeezes like CETX or XSPA, because big vertical squeezes tend to be based on artificial demand, and I think the bounce rate isn't as high because it's fueling up on artificial demand. So when the artificial demand is gone, it's really easy for them to just fall right back down. And if you were trying to dip by that, it's really easy to just totally get screwed over. And like right here, this is a big vertical squeeze, totally just falls. It's a big for this one. This one was a big vertical squeeze, but it totally this one did work. But like you probably would have gotten shaken out here, right? You know, big vertical squeezes like this often, you know, a big large move to the upside often mirrored by a big down move to the to the downside. Part of what I attribute to this is because they are covers and it's artificial demand, so there's no real demand, so it can just come right back. You know, and you see like big huge squeezes have, you know, big nice drops. That was on XSPA, and it was on this one too, you know, like big huge vertical squeeze, and it just comes down, right? So it's, of course it's not going to be every time, but it's happened enough to me to where I just, if it's hugely vertical, I don't like to dip by those. That's just another tidbit that I want to throw in there from the webinar for any of you who missed it. But anyway, hope you got something out of this video. If you have any questions, please feel free to message me in chat. Aloha.